What's up, everybody? Crypto Noah back with another video. This is video number 4 in our passive income series. I did a video on yield farming versus real estate, passive income from rental properties, yield farming versus bonds, yield farming versus dividend paying stocks. And in this video, we're going to be doing yield farming versus trading bots. We're going to compare the pros and the cons of yield farming and trading bots, just like we did in other videos. And at the end, I'm going to talk about maybe when's the best time to use both. I'm also going to break down what trading bots are, as well as what yield farming is. So before we get started, we have to say none of this is financial advice. These are my own perspectives, research, and opinions, and should be treated as such. So without further ado, let's jump straight into the video, starting off with what is yield farming. So yield farming is a way to get a yield on your crypto or your stable coins. So it's 4 ways to get a yield in crypto or DeFi. You can stake your crypto on a blockchain's staking contract, such as ETH 2.0. You can get a yield on borrowing and lending platforms like Aave and Compound, where the platform will facilitate the borrowing and the lending, and they'll pay you a yield for letting them loan out your funds. You can stake your funds on an insurance platform like Nexus Mutual and get paid passive income to facilitate insurance premiums, as well as the most profitable way that we talk about on this channel all the time, staking your crypto on decentralized exchanges and getting paid passive income whenever someone swaps back and forth in the pool you deposited your funds in. Now, what are trading bots? So trading bots are algorithmic trading. You fund your account like some MetaTrader, or you can use like a Coinbase API where it'll do the trades for you. And it's essentially buying and selling with leverage, stop losses, and things like that. Almost like a robot trader, okay? So we're gonna be looking at this chart to compare the pros and the cons in all of these categories, okay? And if it's high, that means it's good. So if it has a high barrier to entry, that means it's easy to get in. Low, it's low. Moderate, it's moderate. So let's start off with the first point, barriers to entry. We have high on yield farming, we have low on trading bots. Let's elaborate. So we have the barrier to entry as low on trading bots because a good bot is actually hard to get in. And if you make one, you'll likely want to keep it to yourself or to a few people because, they do have a cap. Like once you get so big, it's easy to get spotted. People start to copy your trade. Then your strategy is saturated and it doesn't make money anymore. Okay. So the less people that know the strategy, the better. And this is why James Simons, who's like the pioneer of algorithmic trading, he has a book called The Man Who Solved the Markets. It's a good story. You won't really learn anything. And that's the whole point. Like, they're really secretive. He's been delivering great returns since like the 60s or the 70s. He was a NASA code breaker. They still don't know how the hell they're getting these returns. They're so good that there's been employees who tried to leave and they tried to sue the Medallion Fund. That's the name of his fund. Rest in peace to Jim Simons. He just died a few months ago. They tried to sue him because they wouldn't manage their money anymore. Like, that's how good they actually were. He kept it a secret for the exact reasons that I'm telling you. And if it's being sold, it's probably owned by some kind of fund with a very high minimum. So you have to have a lot to get in there. Probably have to be an accredited investor. And if it's a really good algo, you'll have to pay a fee to actually use it before it even delivers the return. So it could be a situation where you pay to use it. This happened to me before. You pay to use it, it doesn't perform, and you just paid a fee for no reason. And there's been a few good ones in crypto, but they don't last long because everyone piles in. The market makers see the strategy, and then they get front run or sandwiched, okay? With yield farming, it doesn't matter who or where you are in the world. You can start with a few bucks. All you need is access to a MetaMask wallet. You can be a felon or a criminal or anyone and make one of those and get some crypto from a centralized exchange, and then you can literally start yield farming immediately. Let's move on to the next point. The next one is time frame, okay? So trading bots, we have moderate. Yield farming, we have high. Let's elaborate. So like I said, the good ones are harder to get into. It can take some time unless you know someone that will take you on as an investor, or you can use like an algo like Unibot. But me personally, I wouldn't trust it. But assuming you know someone, like I said, you can get in pretty fast and then it'll just start trading for you. And at that point, it's just like yield farming. You're just accumulating day by day and you're waiting until you get to the point where you've earned back your principal. With yield farming, like I said, start to finish in a few hours if you don't know jack shit. But if you know what you're doing, you can be in and out of pools in a few minutes. Let's move on to the next point. The next one is the passive income amount. For trading bots, we have moderate. For yield farming, we have high. Let's elaborate. So depending which one you invest into, it can be pretty good, right? And I put it moderate because, that's the challenge, finding it, right? But like I said, once you get in it and it's good, you can be seeing like daily income, like literally every day you hop in there, and you can choose to add in more, which would just compound your returns. The risk is that, what if a stop loss doesn't get hit and it's leveraging and you can lose everything in one trade? That's the thing with algos that you have to worry about. Like, it can be performing well and just one day you lose it all. With yield farming, the yields are high and you can go out of range and be all in one token. And this is why we always tell our members, you never want to provide liquidity for any two assets you wouldn't mind holding on their own. So if you do that and you go out of range, assuming you've done your research and you're providing liquidity for a good pair, there is no way you can lose everything unless the platform gets hacked, which is also a possibility. But, that's why we tell people to only provide liquidity on platforms that's been battle tested, such as Uniswap, such as Trader Joe, Aerodrome, a few of the ones that we talk about on the channel. But the yields in DeFi are really good. And if you look on here, this is our Yield Hunter tool that our members get access to. By the way, if you want to get access to our 13-hour course, professional coaches, and a very intelligent community of yield farmers, all who has each other's best interests at heart, click the link in the description, book a free strategy session. You'll talk to me or one of our coaches. We'll see if our program is a good fit for you. If not, happy to answer any questions and point you in the right direction. I digress. So this is a tool that we have that shows the top liquidity pools in all of DeFi across all these different chains and protocols. You can search by token, you can search by TVL. You can also back test on here. And we're going to be adding some new features really, really soon. But you can see the yields, right? 1,500%, 1,500. Layerzero ETH. I made a video on me getting into this pool actually, but on arbitrum, not optimism, right? So the passive income you can make is really, really significant. And it's based off of trading fees, and you're not using leverage, so you don't have to worry about, what if a stop loss doesn't get hit? Like, can I lose everything in one transaction? Very unlikely. All right, let's move on to the next point. The next one is collateral use. How likely is it that you can use trading bots and yield farming as collateral? We have these both as low. Let's elaborate. So when it comes to trading bots, I've never heard of you being able to use your trading bot as collateral, because they can go to zero in a heartbeat, like I just talked about, if something goes wrong. I've never heard of someone going to a bank and being able to take out a loan against a trading algorithm. The medallion fund, that might be an exception. They might be able to do it if you can show like extremely strong track record, but you definitely have to do some negotiating. With yield farming, you can also do this, but it's new, it's more risky, and there isn't nearly as much liquidity to do this. And I made a video on a platform called Yielder where you can do this on. You can borrow against your Uniswap V3 positions. Since it's not a lot of liquidity, like I said, it's much harder to do if you're a whale or someone with a large position, right? Like if everyone tried to borrow against their Uni V3 positions, probably a 5% would actually be able to do it. Let's move on to the next point. The next point is cash flow stability. Like, how stable are the returns in the short term, right? Like, how dependable is it that you can wake up and be like, all right, I'm getting this today, I'm getting this tomorrow, I'm getting this week. We're going to do long-term stability as well, which is the longer term. So trading bots we have as moderate, yield farming we have as high. Let's elaborate. Most algos are good at spotting patterns, but when things change, that's when they fail, right? Even when they're back tested. This is why it's good to take profits when you get invested into them and not, keep reinvesting back into the same one. Because like I said, all it takes is one mistake and you can lose all your progress, right? With yield farming, you're getting paid passive income just as long as you're in range. If volume increases, you directly benefit because that results in you filling more orders, which means you're making more passive income. Time in the market versus time in the market. We talk about this all the time. If the pool goes out of range, you can rebalance and find a better pool in less than 2 minutes if you know what you're doing and be right back to generating income. It's harder to do that with an algo. Like if one of your algos fail, you're probably not going to want to be like, oh, let me just hop in another one, like you would a liquidity pool. And, given that institutional capital isn't allowed in just yet, it's the best passive income opportunity in history for the layman, okay? So yield farming, it's a little bit more consistent. There'll be some days where volume picks up hella, but with an algo, as a general rule, you never really know unless it's like a really good one with a good track record. And hopefully it's been configured for black swan events as well. Let's move on to the next point. The next one is saturation. How likely is it that this can become saturated? A lot of money come in and saturate the yields or the returns. For trading bots, we have low. Yield farming, we have moderate. Let's elaborate. Okay, so like I said, with trading bots, once it's discovered that your algo is profiting consistently, then people will copy you. And this is the reason why only so much capital can be allowed in. So it's pretty easy to saturate. And like I said, that's why the medallion fund keeps their strategy a secret, right? And then the smaller the market size, the lower your capital ceiling. So if it's stocks, you have a pretty high ceiling. If it's crypto, especially since you have blockchain and you can literally see everything, it's much harder to keep it a secret. With yield farming, there is a risk of saturation, because if there's like a large whale and they find a good pool, they can saturate it and the yields will go down for everyone in that pool. But the good thing is, if you have access to our Yield Hunter tool, you can find another pool to get into just as easy. It's not as easy to do that with an algo unless you're with a good one and they have multiple good algos that are all like really good. But normally they have one or two or a few that's the best and the rest are not as good. Let's move on to the next point. The next one is risk of loss, right? We kind of already talked about this. Trading bots, we have low. Yield farming, we have moderate. Let's elaborate. So like I said, most bots use leverage, which multiplies your gains, but also multiplies your losses. Like if you're using a 30x leverage, if you go up 1%, you're up 30%. But if you go down 1%, you're down 30%, right? All it takes is one mistake and you don't have a significant amount of capital, you could really lose everything. It's just like trust. It takes a while to build up, but it can be lost in an instant. And I know many people who's lost money in all sorts of algos, not just crypto, stock algos, crypto algos, Forex algos, myself included. And you also have, if it's a crypto algo, you have to keep your funds on a centralized exchange, which can also be risky. With yield farm, you do have to worry about impermanent loss. But like I said, this is why we teach people to only provide liquidity and assets that they wouldn't mind holding on their own, because it's like a limit order for the underperforming asset. If you're in an ETH/USDC range from 2 to 3K and it goes above 3K, you're in 100% USDC. If it goes below 2K, you're in 100% ETH. But there are ways to use impermanent loss to your advantage. The biggest loss in yield farming is, in addition to what I spoke about, is smart contract risk. So trusting the exchange that you're LPing on. But like I said, this is why we teach to only LP on the blue chip exchanges. Let's move on to the next point. All right, this is the last point, guys. So long-term stability. For trading bots, we have moderate. For yield farming, we also have moderate. Let's elaborate and conclude. So I think they'll always have trading bots and algos around, especially as AI and technology in general is just becoming more advanced every day. Just the hard part is finding the good ones, okay? And like I said, there are good ones, but the barrier to entry is high for those, and they always will be high because they have limits. As the crypto space increases and the liquidity grows, that problem will start to dwindle, but it's still going to be hard to find good ones. It'll just be easier to hide within all the liquidity. And as far as yield farming goes, I think it'll always be around, but just maybe not in this capacity. Who knows if they're going to have to, if in the future they'll require you to have some kind of license or something. And once institutions get in, things can really change. And this is why we're always preaching, like, let's get these yields for as long as we can while it exists in this capacity. So in conclusion, when it comes to trading bots, you really want to make sure you check the track record and see how it's been back tested, black swan events, you know what I mean? The longer it's been performing, the better. And you want to make sure you use risk management, right? Invest what you're willing to lose, take profits out, rebalance, all the things we talk about. If you find a good bot, throw some in, test it. And yield farming, it's not as risky because it's less likely that you can lose everything in just one fell swoop. But try them both out. If you find a good algo, try it out and just kind of see what happens. But with that, I'd like to conclude this video. If you got value, drop a like, drop a comment, share with a friend. Let me know what passive income strategy you want me to compare next. Other than that, thank you guys so much for tuning in. Love every single one of you watching. And I'll see you in the next video. Take care. Trade safe.